I'm Morella Fernandez. Thanks for joining us today on Market Call. David Burrows on the show with us. He is President and Chief Investment Strategist at Barometer Capital Management. He'll take your questions on North American large caps. Here's how to reach us, 1-855-326-6266. If you want to dial in, you can email your questions as well, marketcall@bnnbloomberg.ca. Thanks for joining us, David.
Great to be here.
Stock markets seem to be reviving. What do you think is pushing the revival at this point?
Look, in general, earnings estimates have been improving. Market has been chewing through some rotation, which frankly has been going on a while. Money moving away a little bit from large cap growth because there are some alternatives. There's some money that is moving out of the US back to international markets. Sectors like financials have been really, really strong. And so I think the market has been going through a balancing process, and it looks decent going into 26.
Have you been trimming any of your tech or AI investments at this point?
Yeah, pretty much every time we've been on through the course of the year, we've said that we had been reducing our tech weight because there are other things to do. To give you an idea, I think that probably technology represents about 11% of firm assets, which would be a pretty significant underweight. There's some great companies and great opportunities still there, but there's a lot of great risk reward in other parts of the market, and relative price performance has been better in other sectors.
Okay, so what are the sectors that you like right now?
So we think that the long-term risk right now is inflation. Every government around the world is erring on the side of fiscal stimulus and fairly easy monetary policy. And so we want to protect against that risk. And so certain sectors do better in that world. Financials are a classic. Low short-term rates and higher long-term rates give a nice net interest margin. They have great inflation protection built in. The power's in the hands of the lender. Materials, industrials, and as I mentioned earlier, international stocks, which are relatively inexpensive and are heavy in those sectors, and as a result are outperforming the U.S. market this year.
Are you also looking outside of North America?
Yeah. We have our typical client account would be 15 to 20% global, not global, international, ex-US, and that's Europe and Asia and Latin America. Partly because, the MSCI All World ex-US index is just about 30% financials. They have a much bigger materials weight and a big industrials weight, and there's lots of great opportunities on those markets.
Okay, we'll take a quick break, and we will be back with David Burrows, Barometer Capital Management, taking your questions today on North American large caps, lining up the phone calls and the email for when we come back. Welcome back, and thanks for joining us. We are going to go to our first phone call. Colin's in the line in Sarnia, Ontario, with a question today for David. Hi, Colin.
Well, thank you, Morella, and David. Thank you for taking my question. I'm trying to follow your advice of buying companies that are good, getting gooder. And I'm watching and drooling as CSU approaches a Fibonacci point, and I just want to know your opinion on Constellation software.
Okay, thank you for the question. Go ahead, David.
So look, this has been a great business over time. It's always had a high quality cash flow stream. It's suffered really from sort of key man risk. Mark Leonard really was the visionary behind putting this capital model together. And the question is whether the new CEO can maintain the same kind of internal rate of return. Our strategy needs three things. We need to like the sector that the stock is in. And right now, software as a whole has been a weaker relative performer in tech and actually relative to the rest of the market. So that's a bit of an X. The second issue is, we want to see strong fundamental characteristics, as you say, good getting better. And this has been a really great company that way fundamentally. Technically, though, the stock is a bit broken. It's trading below the 200-day moving average. So given the fact that there's lots of other things to do right now in other parts of the market, this is just one I would wait to see develop before we stepped in. Now, remember, we're not value investors. We tend to buy relative strength, things that are improving relative to the market. And so I'm willing to give up a little bit off the bottom to actually see that things are improving before we put the money to work there.
Okay, thank you for that reminder. Thank you for that question, Colin. Let's go to John in Toronto with his question. Hi, John.
Yes, hello to both of you. Jolly. Marilla, really appreciate your work. I want you to know that.
Thank you.
Yeah, and David, thanks for helping us out here. Your last appearance, you own Foran Mining. It sure doesn't get much attention or coverage, maybe for a reason. Two questions, David. Would you recommend it now as a buy? And secondly, have you bought more since your last appearance? And thanks again, David. I really appreciate your comments.
Okay, so Foran does copper, zinc, and gold, David?
That's right. So this is a copper, zinc, gold company, here in Canada, and it's a development project. First of all, we really like copper. Materials as a whole, but copper in particular. We think that there's a shortage going forward, and there's really not a lot of new projects that are coming on. It takes a long time to put a mine in place. And if we're going to electrify everything, we're going to need a lot more copper. Foran's in obviously a safe jurisdiction, and it is very interesting. Now, aside from the fact that ultimately it's probably a right target for somebody at some point, a major, stock's been performing well. If you look at the COPX ETF, it's just in the last 3 months broken out of a 10-year sideways base. So technically, that means copper's in a new bull market. And so the intermediate size and smaller size companies can participate in this. We own the stock, and I think it's at a new all-time high today. I'd buy the stock here.
Okay, so you would pick up more even where it's at. That is for John. Let's go on to Jerry then. Jerry's in Hamilton, Ontario, with his question. Hi, Jerry.
Hi, Marilla. David, thank you very much for taking my call. I'm a first-time caller, and I'm calling about Descartes Systems Group. So Descartes, of course, is a software logistics company here in Canada, located in Kitchener. Their last earnings call was very good. Transportation seems to be catching a bid. I understand they operate globally, about 160 countries around the world. So I'm just wondering, would this look interesting to you, and at what price? Thanks again, and happy holidays.
Thanks for the question. So
happy holidays to you.
89.44 is where we stand on Descartes today, but that's down. The high was at the start of the year in February, 122.50.
Yeah, so look, this is a great company. They obviously have capabilities that are very apropos in the world we're in, logistics, in transportation becoming more and more important, AI playing a bigger and bigger part. Technically, stock's weak, and so right now I would need to see it develop. On a very long-term basis, it's traded back to a 200-week moving average, and it held there. So that's positive. But relative strength versus the market has been waning sort of really since the spring. And a lot of sort of mid-sized tech has gone through a similar underperformance. So needs some time. Transport's interesting, like the IYT ETF just recently finally broke out to a new high. So that's something to watch for sure. And some of the big logistics companies in the U.S. have started to waken up, which is interesting. It's a good sign for the economy, but probably a little more work on DSG needs to happen.
All right, let's move on then to Chris. Chris is in Delta, BC. He's got a question. Hi, Chris.
Hello again, Marilla. Well, it wasn't long before there was a natural gas question, Marilla. David, I'd love to have your opinion on ARC Resources. I know you've talked about it many times in the past. It, along with Pembina Pipeline in the first place, and then ARC and Tourmaline behind it, are big weightings in my portfolio. It's a long-term investment, sort of weighing the the bull-bear thesis of oversupply, but the energy build-outs for not just AI, but electrification and everything else where natural gas is likely to play a role in that. I'm wondering what your long-term thoughts are on the sector and where you see value. Thank you so much.
Okay, thank you for the question. Even natural gas starting to come back, David.
Yeah, it's a great question. You know, obviously natural gas just had a big pullback from sort of 550 to 390 in the U.S. and gas price has been weak. It may well be that natural gas a 2026 story. The stocks have consolidated really going back to 2023, early 23. So Tourmaline, ARC similarly. So probably we need a bit more time. You know, interestingly, the Canadian energy producers have really significantly outperformed what's happened to gas and to oil themselves. So that's a good sign longer term when the stocks outperform the commodity. You know, you want to take notice, but you probably want to give it a little bit more time. We have probably more energy exposure than we should have. We're about 10% energy, more in large cap oil. You know, some of them are kind of on the 1 yard line. The hard part is when you're in a bull market, you want to take advantage of the bull market. And, you know, things like precious metals and copper and industrials and financials are really rolling everywhere in the world. Energy is maybe a little bit more wait and see for the beginning of the year, see if things get a little bit better on a relative basis first.
All right, let's take a quick break. Lighting up more phone calls for David Burrows of Barometer Capital Management. Again, he's taking your questions on North American large caps. Back in a moment. Welcome back. David Burrows with us today as our guest. Let's go to Jim on the line in Chatham, Ontario. Hi, Jim.
How are you? Thanks for taking my call. I'd like to know a little bit about Trican Well Service and if it would be a good idea to buy a little bit.
Okay.
Thank you.
Thank you for the question. Trican Wealth is at 564, a high this month of 634, so down a little from the high. What's your take, David, on Trican?
Yeah, you know, a lot of the services companies in energy have been shaping up. You know, Trican is a volatile stock, as you just mentioned. It's been chopping around. It's you know, it's trading above a rising 50-day moving average. It's generating cash. If the sector can get going, it certainly will participate. But I kind of have to put it in the same bucket right now. You know, while we do have some energy exposure, before I added more, I would probably need to see it start performing a little bit better. You know, I keep going back to the fact that there's other sectors right now that really are clearly in gear. And so, like, let's take advantage of a strong market. And you know, it's nothing worse than owning a good company when nobody else cares. Okay. So just probably give it a little bit more space. See the sector start to wake up. See some better performance. You know, even if you pay a little higher price, you know, then you're getting a timely purchase.
When you say wake up, you mean stabilize, not be as volatile, or what do you mean by that?
Well, a couple of things. First of all, a stock where there's a very tight supply-demand relationship, meaning there's buyers right under the surface, shouldn't be trading in as wide a band. It means sellers have to push further lower to get out. So we like to see companies trade in very narrow, tight band. It means there's lots of buyers under the surface. Second of all, I want to see the technical picture get better. You know, I want to see some relative price improvement. Trican's traded better than about 50% of the stocks in the S&P over the last year. There's a ton of companies performing better, and the sector needs a little bit more momentum before I think you want to put money to work. When you've got sectors like the financials doing what they're doing, and when you've got industrials doing what they're doing, and when you've got precious metals and copper doing what they're doing, international stocks, like, focus in the areas of leadership in the market, because you don't know how long a bull market's going to last. We think that likely energy follows along. Generally, precious metals go first, base metals go second, energy goes third, and now base metals are engaged. So wait and see a little strength, be willing to pay a little higher price, but know that you're now in a leadership part of the market before you go. Now, I'm just not the investor that buys something that's out of favor and waits for it to get going.
Okay. All right, let's go to Kevin. He's on the line in Toronto with a question. Hi, Kevin.
Hi there. Thank you, David, for taking my call. I know you're bullish on financials, and I'm thinking TD Bank. It's had a really strong run over the last 7 months. Would you still step in at this price? And would you prefer an American bank if you are bullish on banks in general, or would you stick with TD Bank? Thank you.
Okay.
David, go ahead.
So I'm going to pull the lens back, which is what I like to do. I come at things sort of from a macro perspective. And sectors and themes go through periods where they're in favor and where they're out of favor. And you get into a structural or a secular bull market, it can go on a long time. In 2020, we went from falling interest rates for 40 years to what is likely rising long-term interest rates for the next 25 or 30 years. That benefits banks in particular. And if you looked at the XLF in the US, after going nowhere from 2008 to 2021, it finally made a new high. That's the beginning of a new long-term bull market that probably goes on 10 or 12 years. During that time, earnings go up, dividends go up, and the multiple expands. So the US stocks joined strength in Canada. Canadian banks have been performing better. And since then, they've all been doing well. And as you know, TD's had a wonderful year this year. Well, so have the American banks. JP Morgan have used as a top choice many, many times, and it's been a great holding as well. This year, the European banks joined in. And so, one of our top picks 6 months ago was Santander, SAN in New York, which is the largest global bank outside of North America. So banks, 95% of banks globally are trading above a rising 200-day moving average, and they are in, depending geographically where they are, like the first 3 years of what is likely a long-term bull market. Don't be afraid of a bull market. So TD looks great. I think Santander would be a great add to any portfolio. Some of the other European banks look good as well. The U.S. capital markets banks look really strong. We own Morgan Stanley and JP Morgan as top 10 holdings. This is good risk reward, especially because they are dividend growth stocks. And when there's inflation, a rising stream of income is pretty attractive to offset a rising cost of living.
Okay, so look around in the financials for that. Let's go to Steve in Thornhill, Ontario. He has a question today. Go ahead, Steve.
Hi, best of the season to everybody. I would like to ask Mr. Burrows what he thinks about investing in the healthcare/biotech sector of the economy, and if he thinks it might be a good time to put some money to work there, what recommendations would he make?
Sure.
Okay, thank you for the question.
Well, great question. This sector, the healthcare sector in the U.S., was a serial underperformer from March of 23 until this past summer for many reasons. And it doesn't matter whether it was devices or health management companies or pharmaceuticals. Having said that, things have started to change. The biotech sector's wakened up. If you take a look at the XBI, that's an equally weighted basket of biotech companies, certainly performing much, much better. There are lots of individual names that look good. I'm going to use a top pick from healthcare for the first time in a long time today. So we'll talk about one in a little while. But XBI would give you a great exposure to the biotech sector. And it's a good way to do it because, as you know, biotech stocks can be really volatile. And if the sector's coming into game, it would be a great way to build a small base in your portfolio with some exposure there. I'll come back with a specific name in our top picks.
Okay, Steve, I hope you stick around for that. Let's go to Paul in Prince George, BC. Hi, Paul.
Hi, thanks for taking my call. Mr. Burrows, you had mentioned $330 as a stop on Broadcom, and I saw it went below that briefly, and now it's back up above. Do you still own Broadcom, and what are your thoughts? Merry Christmas to both of you.
Thank you very much.
Merry Christmas.
Let's look at Broadcom.
So, as you may know, we use point and figure price charts to help set stops. And on a high dollar company, we tend to make them a little bit less sensitive. So I use a 10 box size, and I don't want to get into the weeds. there were two very clear price points that we wanted to watch. One was $330, one was $320. And we had a long drawn out conversation, James Callahan and I, our lead guy on US Tech, and chose to use $320. It's been on the 1 yard line over the last 3 weeks. It's rallied off it today. Semis look like they have gone through, a bit of a flush with Broadcom, selling off after the earnings. So we still own it. It's $335 today, and our hard line in the sand now is $320. And it would be gone. The other name that we own is NVIDIA, and it has languished over the last few weeks, which is, a reason why we're sort of happy we have an underweight position. And we own Lam Research on the equipment side, and Lam actually has been very, very good, LRCX, and which is a pretty good tell when it's making new all-time highs today. And so those are our three positions in semis, and we continue to own all three.
Okay. Paul, I hope that works for you. Let's take a quick break. When we come back, I'll look at David's past picks. That's next. Time now for our top picks from David Burrows. Picks from April 14th of this year. And at the time, David, you chose Wheaton Precious Metals, WPM. On the TSX, it was $115 at the time, and now up to $162.42, so 41% upside, 42% in total returns. Do you remember why you liked Wheaton Precious at the start of the year?
Yeah, I think that we probably talked about 7 or 8 precious metals companies over the course of the last 18 months as top picks. It's pretty simple. Central banks have been driving purchasing of gold over the last 2 years at a rate we haven't ever seen. And so it's not even investor demand. It has been central bank buying. These companies are highly leveraged to the price of gold. Wheaton Precious Metals is a great way for an investor to have exposure to silver. They have 60% net profit margins, and these companies are not being priced based on where the metal is currently. So this is a premium company. It's got very strong growth, and if you like a dividend grower, this is going to be a dividend grower. So we've owned it for the last couple of years, and I would buy it here today.
Okay, that was Wheaton Precious Metals. Let's get to your next past pick. Expand Energy, EXE, on the NASDAQ, exploration company, gas and oil. 104.23 at the time, U.S., now to 108.10 U.S., a return of 4%, total return of 6%. Did you or are you still invested in Expand Energy?
Yeah, no. So if you look at our typical portfolio, we own 20 to 30 companies. And those are supposed to be the 20 to 30 best companies we can find, as time goes by and markets morph and change. And so when we see something that we own, maybe it's not performing poorly, but there's something better to do, we'll try and trade up in quality. I mentioned that we were a little more cautious on natural gas, and other sectors have continued to do well. So we sold it not because we thought it was a bad company. It's actually a premium producer of natural gas in the U.S., but we just think there may be other better opportunities, so we moved on.
Okay. Your last pick in April was cash, and I'm wondering if you have deployed more cash since then, or what you're doing with cash.
Yeah, it's a good question. So we're a tactical manager. As if you remember, April was a very sloppy market. Market was questioning earnings growth for the rest of the year, and so we came out of some positions. We track breadth, so the percent of stocks that are performing well in the market. When breadth starts to contract, that tells us there isn't enough new money coming into the market, or there's enough money leaving where risk reward's not so good. So we like to raise a little cash in those circumstances. Obviously, since then, markets got a lot better, and we put money to work. We probably have 5% cash across portfolios, but we're pretty fully invested. And most of the cash we continued to rotate toward international and materials.
Typically, if there is a typical for you, how much cash do you put aside?
if our breadth models are positive and we have lots of opportunity, we'll be fully invested. Okay. If markets start to weaken, if our models turn negative, we'll tend to raise 7 or 10% cash, and then we use stop losses on all of our positions. If our positions just sail through, that's wonderful. If they start hitting our stops and breadth is deteriorating, our cash position will build, which doesn't protect us in the first 4 or 5 weeks of a sell-off, but as it picks up, our cash position builds and we get more and more cautious. So it really depends. Markets change. We have to be ready to change the portfolios.
Okay, we will leave it there. We'll take another break. David Burrows with us, Barometer Capital Management. He's taking your questions on North American large caps. Back in a moment. Welcome back to Market Call, and thanks for joining us. Let's go to Chad on the line in Saskatoon. He's got a question today for David Burrows. Hi, Chad.
Good afternoon, Marella and David. David, my question is on silver. I missed the boat buying any gold stocks here in the last year when they had their run. Now that silver's going up, I was hoping that you could help me pick with one of your highest conviction silver stocks or an ETF.
Okay.
I'll hang up and listen. Thank you.
Okay. David, I know you said you like momentum stocks, and I'm wondering when you get into the momentum, has silver already moved up too far for you to buy in at this point? How do you determine when it's a good time to buy in on a stock that has momentum?
Right. So Marella, precious metals bull markets tend to go on for 8 or 10 years, and they happen in phases. So there will be 2 or 3 good-sized corrections along the way. The correction that we saw through early fall, frankly, was shallower and lasted less time than I expected. But we are fully positioned in precious metals. Silver has a tendency, once a bull market starts to really mature, tends to outperform, which it is now doing. And, it is famously volatile, so you have to keep that in mind. Our impression is that you want to stay with the best-in-class operators always and the best assets. So someone who's finding something in the ground may wind up with a home run. I don't really want to bet on that. We want to start with something that's good and hope that it's getting better. In the case of Pan American Silver, which I would take a look at, it's the institutional favorite. Probably 65% of the shares are owned by institutional investors who are fairly sticky holders. They recently, made the acquisition of Mag Silver, which was completed in the fall of 24, and that really structurally improves Pan American's cost structure, which is world class. It's the cash flow growth in these precious metals miners is off the charts. They are not valuing these companies at current prices, and my guess is likely silver prices and gold prices are going to continue to go higher. So if you think that one of the biggest risks to our portfolios is the impact of inflation, well, this is a classic inflation hedge. So they should have improving margins. It is the leader in the group. It is, it's in Mexico and Peru, which are both pretty good jurisdictions. And, the stock will have corrections, but I think that it's a great way to play it. The other way, of course, to do it is through a silver ETF. And, I might look at SILJ or SIL senior producers or junior producers as a supplement. But between Wheaton and Pan American, I think that they make a pretty good duo.
Okay, so a lot to chew on there for Chad in Saskatoon. Let's go to Jim. He's in Peace River. Hi, Jim.
Hi, how you doing?
Good, thanks.
All right, I was wondering about Cenovus. I already own them, and I really enjoyed that Meg takeover. Where do you see them 5 years from now, please? Thank you very much. I'll hang up now.
Thank you for the question. Are you invested in Cenovus, Dave?
So we don't own Cenovus currently. It's a company that certainly is on our list. We always keep a farm team, things we'd like to own. If relative strength and energy were to turn higher, it would certainly be a potential target. It's trading above a rising 50-day moving average, which seems to be some decent support here. Long term, I think the stock probably is a great buy. Just tactically, in the short run, we're not adding any energy until we see some technical improvement there. But the acquisition I thought was excellent, and it would be on our list if things start to get a little better.
Okay. Let's move on to Nelson, who's calling from Portland, I believe. Hi, Nelson.
Hi there, David. Could I please have your thoughts on BHP, Bills? And it seems to be dragging its heels these days. I'm making a little bit of money. How would you compare it to Rio Tinto Zinc? I'll hang up and listen to your response.
Thank you for the
Great question. So, we own in base metals, we own Hudbay, which I've used as a top pick, and that's really the leader. We own Foran, which I talked about earlier, and we own Rio. BHP, of course, is in the same group, but keep in mind, BHP has just a very, very large iron ore business. And the iron ore business is probably a little bit of a drag. It's a great diversified commodities producer. It will be a great dividend grower over time. But in the short run, it's lagging a little bit. I would prefer Rio over BHP.
Okay, that was for Nelson. Let's take a quick break. We will line up some more phone calls and some emails for our guest. David Burrows taking questions on North American large caps. We're back in just a moment. Here's how to reach us. Stay tuned. Welcome back, and thanks for joining us here on Market Call. Let's go to Robert. He's on the line with a question. Hi, Robert.
Hi, David. Your thoughts on Uber for long term? Thank you. Bye.
Sorry, I missed the question. Did you hear him, David?
Yeah, the question was on Uber.
Thank you.
And look, the long-term picture for Uber is very attractive. Obviously, it's a disruptor and has turned many of the industries it's in on its head. The big question is how soon for robo-taxis, and how many hoops do they have to jump through to get to that point? They are seeing really nice pickup in cash flow. In the near term, they've had some very high expenses around regulatory issues and getting approvals for self-driving and the costs of bringing those autonomous services into the market. Technically, stock sold off recently. It's below the 200-day moving average. I would give it some space. Many of the higher multiple growth stocks have been weaker. In the last 3 months, value has started to outperform. And that's not to say that's forever, but some of the key sectors we've talked about today are more value-oriented sectors. And so I think some of the very large cap sort of tech-related companies have been seen as a source of cash to put money to work in some other sectors. I'd probably wait just a little bit longer on that one.
Okay, that was for Uber. Robert had that question. Let's go to Kenny. He's in Vancouver with a question now. Kenny? Kenny, are you there? Okay, so I think the question was about MDA Space, which did get a little bump on some Ottawa work that has moved their way, but still hasn't fully recovered from the hit when it lost, I believe, the EchoStar contract months ago. What's your outlook for MDA Space?
Well, unfortunately, we got caught in that. We owned MDA Space when that news came. It briefly, held the 50-day moving average and rallied to just around $40, but then technically failed, and so we moved to the sidelines. And I think that there's just other things to do for now.
Okay, out of MDA Space, let's go to Peter in Sarnia, Ontario. Hi, Peter.
Good afternoon. Marella, thank you very much for being so fast and efficient and professional with your calls. You're getting so much more of us in there. My question's on Canadian National Railway. which has been a bit of a funk for the last year. Are we looking for the same sort of progress coming up this year, or do you see a more positive outlook? Thank you.
Interesting question, Peter, because a lot of people are looking at transportation, and I know some are saying there's going to be a rebound for transportation in 2026, and rails are so low right now, they're picking it up. How do you feel about it, David?
Yeah, and it's a great question, and we're watching that as well. With the IYT breaking out, pretty darn attractive. It's been more the logistics companies that have caught a bid. The rails in general have continued to underperform, so they obviously need a little bit of work. And we'll see when the price of oil is low and the price of diesel is lower. Trucks can be more competitive. When price of oil is high, the rails have a real big advantage, and they tend to win more traffic. So it looks as though oil prices may stay a little lower. There seems to be some oversupply in the near term. So I'd probably give this a little bit more time before putting money to work there.
Okay, that was for Canadian Rail. Let's move on to another caller in Montreal. Nicole's on the line. Hi, Nicole.
Well, thanks for taking my call, and I have a two-part question for David today. First, I'd like his thoughts on GE Aerospace, and the second part, which is of utmost importance, do you think we'll have a Santa Claus rally this year? Happy holidays, and super job, guys.
Thank you.
Bye-bye.
So some are saying we're getting to that Santa Claus rally now, a little bit late, but just under the line for Christmas. Are we at a Santa Claus rally point now? Do we expect any more before Christmas?
So the actual definition of the Santa Claus rally is like the last 5 trading days of the year, and we're there. So I think we're into it now. We will always watch the condition of the market coming into a period of time, because market continues to continue on. In general, breadth has been improving since late November in the U.S. and Canada and internationally. And so the conditions are pretty good, and there's some pretty clear leadership. And today, after some pause, it looks like some strength is resuming. So I think that we're probably in the Santa Claus rally. As it relates to GE Aerospace, aerospace and defense has been key leadership in the market for 2.5 years. And we have been a holder of GE Aerospace. We continue to own it. But companies around both commercial and defense aerospace have been big winners. GE Aerospace in particular, because the next generation of jet engines has been delayed, and so there's been a lot of service revenue available to GE Aerospace. Howmet Aerospace, HWX, has had just a fabulous 2 years. Raytheon is performing really well. It's the right group. Relative strength continues to improve. And it had a little pullback recently to well above the 50-day, above the 200-day, and I would be a buyer of the stock here.
Okay, that was for Nicole in Montreal. Let's go to an email from Sophia. She says, will you please tell me what you think of Northland Power? Is it worth to hold or take a loss at this point? We'll pull up the Northland Power line chart, have a look at where it's at today. Is this one you know well, David?
We haven't owned this for a long time. They have a history of spending a lot of money on development, getting it going, getting it to start paying, and then they commit to another big project and, require a lot more capital. In general, with long-term interest rates staying high, I think it's very difficult for companies that are very capital intensive. So the cost of financing when long-term debt pricing is high is onerous. And so, we have sort of stayed away from these types of companies. And obviously, after it's had a break like this, just think about it. Literally every shareholder is losing money right now. And everybody has a price in mind. They just like to see it get back to their price, and they'd be a seller. So a company like this has a ton of built-in sellers. And we just don't tend to try and buy turnaround situations. Let other people do that are better at it.
With a situation like this, as you mentioned, they tend to invest a lot more. It might be capital heavy, expense heavy. So should she sell? Would you recommend she sell and look for other places to make money?
I would move on.
Yeah. Okay.
I would move on.
All right.
Think about this. These banks, for instance, or the copper producers that we talked about earlier, they're making new all-time highs. Every shareholder's happy. every shareholder is happy. And people see the strength in the sector. There's new buyers coming to it. Right now, this is a sector that's been tough. It's a stock that's been tough. Everybody's underwater, and there's a lot of built-in sellers. So, don't wait around. I would move on.
All right. Let's leave it there for this block. That is it for phone calls and emails today. But we will be back with David and his new top picks. Stay tuned for that. Join us on Monday for Market Call. Lyle Steen will be on the show. He is president of Forvest Global Wealth Management, and we'll be taking your questions on North American and global stocks. Time now for new top picks from David Burrows. We're going to begin with Rio Tinto, RIO, on the New York Stock Exchange. Rio Tinto going through a transition, and this is one I think you like what's coming down the road for them.
Yeah, so first of all, if the background premise is that we've entered a structural bull market for commodity prices, driven by the fact that for 15 years, weak prices meant nobody invested in new capacity. There is scarcity. Our most important thing we're hedging against is inflation. And the thing about a metals producer is that as costs go up, they put their prices up. Rio Tinto is a global dynamo that has been going through its own catalyst transition toward, energy transition metals, copper, lithium, aluminum, which have fairly inelastic demand, given the growth in demand. So this is a company that we think, as commodity prices move higher, their earnings and cash flow can double, even potentially triple. If the sector is in a long-term bull market, it tends to be the multiple that investors are prepared to pay starts to expand. So if you get earnings doubling and the multiple that can double and dividends that could double, that adds up to a lot. Rio has had a history of paying large special dividends, which is a nice thing to get while you're waiting. And it's a very well-diversified company in the sector. Technically, the stock looks very strong, having broken out of a multi-year base, and it's a global leader in the space.
Okay, that was for Rio Tinto. Let's get to your next pick, Eli Lilly on the New York Stock Exchange, a well-known pharmaceutical company, also participating in growth with essentially weight loss drugs. What's coming down the pipe for Eli Lilly?
Yeah, so as we look at it, when a sector's out of favor, it doesn't mean we don't care. We build a farm team, things we'd like to own if the sector started to wake up. As somebody mentioned earlier, the last 3 months, we've started to see some improvement in the sector. And almost immediately, Lilly went to a new high. Now, it quickly got a little extended and then pulled back to where it broke out. So Lilly is going through transformation. Obviously, they're seeing massive growth in the GLP-1 drugs, Mounjaro and Zepbound. And that has shifted the company from being a boring, steady income earner to a real growth stock. So technically, it's broken out of a very nice base. It is clearly a leader in the pharma sector. We can see multiple expansion in earnings growth. And it's hard to imagine that the growth in weight loss drugs is going to slow if they're able to move from an injection to a convenient oral pill. So this is, I think, our poster child for what we want to own in healthcare, and the market is clearly going to grow.
Okay, let's get to your next pick, which is Tesla, TSLA on the NASDAQ. And this is more on the idea that this company is getting into autonomous driving. We had Elon Musk talking about how well their Austin run out has been going, and also robotics coming up for this company.
Yeah, so Tesla is a wonderful company, and I haven't spent a lot of time talking about growth stocks over the last year or so. Tesla spent 4 years trading sideways in a technical base as it was growing into what's coming forward. But now we have a bunch of catalysts in front of us. So in the last 3 months, there's been a very clear shift in relative performance from the hyperscalers who are building AI machines and models to the AI adopters. And Tesla is clearly an AI adopter. This fleet of cars they have, built them data and an AI machine that is uncomparable, and really not too different what you're going to need to run their robots than they're going to need to run cars to be able to walk around and navigate themselves. So, we've got robots coming at us, the Optimus. You've got their robotaxi business is going to come at us over the next 2 years. The most recent version of autonomous driving is, quite amazing. I've been driving a Tesla for 10 years, and it's quite astonishing how little intervention you need today. So they are a classic physical AI company, and just broken out to new highs. I think the timing is excellent.
Okay, that was for Tesla. Let's leave it there, David. I got to go because we're out of time. Happy holidays to you. Thanks for joining us today.
Thanks so much for having me, Marella.
Okay,
Merry
and
Christmas.
thank you. Merry Christmas. Thank you for joining us today on Market Call as well. We'll see you back here again on Monday.